It's the Wealthy Pilots Podcast with Scott Osborn and myself here to talk about Fed rate cuts. Scott, we are winding down the year, my friend. We are 3 days before Christmas at the time we're taping this and dropping this podcast out. So talk a little bit about the Fed rate cuts and what's going on there and what that might do to things. So how you doing, my friend?
Great. Yeah, really good. Getting, as we talked about, ready for Christmas here.
Are you ready?
We got a couple packages for Andrea to come in. She's got all her stuff for all 7 of the kids taken care of, so she's on it. I don't ever envy her this time of year, that's for sure. So.
Well, as a gentleman with 7 kids and a lot of stuff going on, buying Christmas presents gets a little costly. How do you feel about the Fed rate cut? Let's talk about it a little bit. Would you have liked to have seen that a little earlier?
Yeah, I mean, I don't know if it impacts our Christmas shopping.
No, it really doesn't.
Because we're,
it's my segue though.
Yeah, it was good. I liked it. So, I think, the Fed rate cut, it's a good news for investors, right?
Yeah.
I think as, post-election, when we look at, the new administration coming in and some of the market rallying behind that and a lot of the economic or economic data looking favorable.
So far,
there was a little bit of risk there, I think, of like the Fed probably hanging on to rates where they're at just to prevent things from heating up too much. So I think, they've been indicating this quarter point cut for some time and kind of been pretty transparent that they plan on doing that. So I think it's a good thing it's a good thing for borrowers. It's a good thing for, the cost of capital coming down. And ultimately, it's definitely going to be a good boost, I think, going into the new year, new administration, new economy here.
So they're taking taking that range down. So if they go through with this here, and of course, they haven't done it at the time we're taping this, so they probably will do this over Christmas break, if I'm not mistaken. But they'll take us down to that 4.25, 4.5 range, yeah?
Yep. Yeah. So, I mean, when you look at like how businesses are running their balance sheets and trying to figure out like what is the cost of capital, and they're running their net present value calculations and return on invested capital and all that kind of thing.
Right.
The interest rate is a huge part of that. So for when we look at like America's largest companies that are borrowing significant amount of money to invest in their organizations, the lower interest rates really reduce the risk of the investment. Mm-hmm. And so, what we should see is increased investment in American companies. And so when you look at that, it means a couple of things. First of all, our companies that are headquartered here out of the U.S. are going to continue to invest aggressively.
Which is what Trump wants, obviously, based on the rhetoric, and which is going to help with the cost of goods and services and all that good jazz, right?
Correct. And so when we see the opportunity to invest look more appealing, you'll typically see dividends stay a little bit more stagnant because they're looking at more trying to grow the company because it's more efficient to grow the company instead of just paying the cash out or the profits out in the impact of a dividend. So,
and that's a good point, because 24 has been weird, right? Because the market's been great overall, right? Mm-hmm. But profits have not been good for companies of all kinds of sizes, right? Due to inflation, due to cost of goods and services, so on and so forth. It's been a really weird dynamic in that, and I think that's why they've been this is the third rate cut. I think it's going to be the final one, obviously, for this year. And then, so they've been, to your point earlier, they've been kind of, squeamish about what to do because they don't want to stall it out, but they don't want to also, curtail or cause other problems. So it's been a real fine line to walk, and companies have it's been a strange place to be.
Yeah, I mean, we've had pockets of recession throughout different aspects of the economy. I mean,
yet the market's boom, which throws people off. They're like, "What in the world?" Right? So,
well, and this is where if you have a diversified portfolio, which we highly recommend,
sure,
the downside of diversification is you're always going to own some sort of dog in the portfolio.
Right.
If you have $0 to invest or in your accounts and you start investing a lot of money, just owning the S&P 500 can be a really good investment.
Sure.
To grow the accounts. But when you start getting a decent account balance, avoiding losses becomes as mathematically important as it does getting large gains through the returns as well.
And if you do have them, to your point, which you're going to probably have, I mean, that's why working with a professional to help tax loss harvesting at the end of the year is important, because then you can kind of trade some of those gains that you more than likely had, with some of the dogs that you probably have.
Well, and that's where, you look at this year and the majority of the gains, it's the Pareto principle, right? I mean, 80% of the gains are from the top 20% of the companies.
Right. Yeah.
And so if you have taxable accounts, I certainly hope you've been taking advantage of some end of year tax loss harvesting, because you for sure in this economy have some holdings that are down. And to be able to, offset some of the capital gains you have with some losses and still stay invested in the market makes a lot of sense for just about everybody out there. So, there's a lot that you can do there, kind of taking control of your own destiny. But, I know we're going to get into this here in the upcoming episodes too, but this also kind of feeds into the savings and investment plan that you have. If you're just plowing money into the 401k and that's it, you can't really take advantage of these tax strategies outside of the 401k. So, it really has to do with like just what's going on inside of your plan, and then how do you take advantage of what's currently going on in the market and economy. So, we can't predict everything that's going to happen from the rates. We know historically what happens. We know we should see the bond value slowly climb up with the lower rates. We should see capital flow at a higher rate into the economy as the cost of borrowing U.S. dollars goes down. So I think it's a good thing for the United States in total. I think it's a good thing for a lot of our people that are looking out there to buy homes too. We should see the mortgage rates come down to a little bit more affordable, like 6% range sometime next year. So, if we can get that under 6, that gets to be a little bit more affordable.
It makes it a little easier, especially with the prices still really not doing a whole lot yet. They're still kind of holding their own. And it's interesting. So, I said we're taping this at the time we're taping this. We'll drop it on Thursday, so the announcement will have been done. But we're taping it before Fed Chairman Powell takes the stand or the stage and has a conversation, which is usually, I think it's gonna be like 2:30 on Wednesday, which is when we're taping this. But they're saying inflation, Scott's down at 2% now, right? I still think we feel like that's a little bit, bogus, but whatever. they're saying, which is part of the reason why they're saying that they feel they can make this cut as well. But it has eased off, right? And so I think we'll continue to see more of that, as we get into the new year, especially if we start getting more energy independent again. So that's going to make a big change in the first quarter as well.
Yeah. Well, the inflation data is really interesting too, because it's like, yes, it's cooled down on a rolling 1-year basis.
Right.
But if you look at it over 3 years, it's bad.
Yeah.
It is bad.
Yeah.
Because we had that real big blip where it basically went up about, in some markets or some
9% was the claimed high point, right? Yeah, but you felt like
but
it was
that means
22.
like maybe groceries were up 25%, right? And so you have those pockets of things that were important to people's everyday lives that went up a significant amount. So
used cars at one point were 42%.
Oh, dude, I had to buy 3 of them for my family in 1 year. It was a brutal time to do it. So
there you go.
But you had that scenario play out where yes, the data is looking better, but that's where you got to look at more than just the data that the headlines are feeding you to. So there's the inflation data specifically, it's going to take a decade until we can kind of calm that down. We need to be at 2 to 3% for a while here to let everybody recover from, a 10 to 20% increase in cost of living based on.
Oh, it takes a while. And what CPI index are you looking at? Are they looking at, right? There's like 4 or 5 of them, right? They don't really use the one they should. They use one that does all sorts of goofy stuff. So, it's going to be interesting, but we'll see what happens with the Fed rate cut. I think, obviously for borrowers, this is obviously an important thing, which again can be good for business, which can be good for business growth, which could lead to job opportunities. So hopefully we'll see some improvement there. Any other thoughts on that?
Yeah, I think the big thing is, you don't want to make too many long-term decisions based off of short-term, market implications. So, yes, the rates are coming down. That's good. But ultimately, if you're a hardcore market timer or something like that, maybe this kind of information is driving you to make different investment decisions. But at the end of the day, if you have a good investment plan, you should not really care about what the Fed's doing this quarter. That's for darn sure.
Yeah, and we talk a lot about, obviously this is the Wealthy Pilots podcast, but there's also a lot of pilots out there have small businesses, right? They have their own kind of stuff. You have your own small business, so on and so forth. And so again, with the economy and the way things have been, these Fed rate cuts can be helpful, especially if you're trying to, maybe reinvest back in your company to help grow, right? To maybe bring on another pilot or, whatever the case might be. So just make sure that you're, double checking your numbers and rehabbing those conversations with your financial professional. Could be useful. We'll see. We still got a lot of stuff happening in the first 90 to 180 days of the next year that we'll see how how it shakes out.
Yeah, a lot to come, but I think as far as like a key takeaway for our younger folks, man, just keep buying. Plow it in. We're going to talk in the next couple episodes here about, I think, some good decisions on where to invest outside of the 401k. But for our folks that are, maybe hitting that last leg of their career and they got 5 years left to work, well, the interest rate thing, when you're starting to build out your stockpile of safe money that you're going to land in retirement, this does factor in more into those projections and into your income plan. So definitely, if you got 5 years or less of flying in front of you want to be looking at your plan and making sure that you're getting the right assets set up for you for future income for sure.
All right, folks, we're going to wrap it up. So go check out Scott online at retireairlines.com. That's retireairlines.com. We're going to be doing some podcasts we'll be dropping over the holiday break, over the Christmas and New Year break. So check out some of those new shows by subscribing to us on whatever platform you like using, Apple, Spotify, YouTube. So click on the little links there. We'll have all the links in the show description so you can get in touch with Scott. Or if you've got some questions, need some help, just reach out to him. And like I said, don't forget to subscribe to us so you can catch new episodes of the Wealthy Pilots podcast when they come out. We'll see you next time. Thanks for hanging out, Scott. And actually, I think before we tape this next one, Merry Christmas to you.
Merry Christmas to you too, Mark, and all the listeners out there. We appreciate y'all.
Yeah, absolutely. We'll see you guys for an episode right after Christmas here on the Wealthy Pilots podcast.
Information is for illustrative purposes only and does not constitute tax, investment, or legal advice. Always consult with a qualified investment, legal, or tax professional before taking any action.